Hello, my dear students. A very warm welcome to all of you in Shri Jayendra Rank Zone. I am your friend and mentor for the subject Principles and Practices of Accounting. In this lecture, we'll continue with Accounting Chapter 5, that is Concept and Accounting of Depreciation. So let us begin. This is lecture number 17. Let us write an illustration. 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 The following particulars are available from the books of X Limited, provision for repairs and renewals as on 1st of April 2016, rupee 1 lakh. Actual repair charges incurred during 2016 and 2017, rupee 60,000. During 2017 and 18, rupee 90,000. Rupee 90,000. X Limited transfers annually a sum of rupee 80,000 to the provision for repairs and renewal account required prepare the provision for repairs and renewal account for the year 2016, 2017 and 2017, 2018. I believe you understood till here. Let us see the question once again. The following particulars are available from the books of X Limited. Provision for repairs and renewals as on 1/4/2016, 1 lakh. Actual repair charges incurred during 2016-2017, rupees 60,000. During 2017-18, rupee 90,000. X Limited transfers annually a sum of rupee 80,000 to the provision for repairs and renewal account required. Prepare the provision for repairs and renewal account for the year 2016-17 and 2017-18. Solution. Solution. Provision for repairs. Provision for repairs and renewal account. Renewals account. Date, particulars, date, particulars, amount. Date, particulars, amount. March 31st, 2017 to bank account, to bank account 60,000. 60,000. See it over here. Actual repair charges incurred during 2016-17 is 60,000. Actual repair charges is 60,000. So to bank account 60,000. Opening balance is 1 lakh over here. 1/4/2016 by balance brought down, it is 1 lakh. By balance brought down, it is 1 lakh. X Limited transfers annually a sum of 80,000 to the provision. So from profit and loss account, a sum of 80,000 is transferred to the provision 31st March 2017 by profit and loss account, by profit and loss account 80,000. 80,000. The total is 1,80,000. The total is 1,80,000 minus 60,000, 1,20,000. To balance carried down. To balance carried down 1,20,000. To balance carried down 1,20,000. Over here, 1st of April 2017 by balance brought down, by balance brought down 1,20,000. By balance brought down 1,20,000. Annually 80,000 is transferred. So by profit and loss account, by profit and loss account annually 80,000 is transferred 31/3/2017, 31/3/2018. Annual repair charges is 90,000. So two bank account annual repair charges 90,000. 31st March 2018 90,000. Let us close it. 120 and 80. It's 2 lakh. 2 lakhs. We are closing it for 2 lakhs. 2 lakhs minus 90,000. 1 lakh 10,000. 1 lakh 10,000. 2 balance carried down. 2 balance carried down 1 lakh 10,000. I believe you understood. I believe you understood this, how to make provision for repairs and renewals account. Let us move ahead. Learn some theoretical aspects of this chapter. Let us learn the meaning of provision first of all. Meaning of provision. The term provision refers to any of the following. Any of the following amounts. A. The amount written off or or retained providing by way of providing for depreciation, renewals, or diminution in value diminution in value of assets or the retained amount retained by way of by way of providing for any known liability of which the amount the amount cannot be determined with substantial accuracy with substantial accuracy. Let us write some examples of provision. Examples of provisions. Examples of provisions. Provision for depreciation. Provision for depreciation. Provision for taxation. Provision for taxation. Third, provision for doubtful debts. Provision for doubtful debts. Fourth, provision for discount on debtors, provision for discount on debtors, and fifth, provision for provision for repairs and renewals, repairs and renewals. Why do we make provision? What is the objective of provision? Objective of provision. Provision is created to cover a loss. Provision is created to cover a loss in the value, loss in the value of assets, or a loss or expenses or expenses, the amount of which cannot be cannot be determined with with substantial accuracy, with substantial accuracy. Need for provision for doubtful debts. Need for provision for doubtful debts. Need for provision for doubtful debts. A provision a provision for doubtful debts is cover the loss created to cover the loss of possible bad debts by means of by means of a predetermined percentage predetermined percentage of net debtors, that is debtors less bad debts. Debtor less bad debt is known as net debtors, with a view with a view to bring in with a view to bring in a certain element of certain element of certainty in the amount of certainty in the amount of bad debts bad debts bad debts charged bad debts charged for each accounting period for each accounting period. I believe you understood. I believe you understood this. Need for need for provision for need for provision for discount on debtors. All of you must seen this in the statement of financial position, that is the balance sheet. Provision for discount on debtors. What is provision for discount on debtors? Provision for provision for discount on debtors is created. Debtors is created to to provide for discount to provide for discount likely to be allowed likely to be allowed on on good debtors on good debtors on good debtors. That is sundry debtors less additional bad debt given outside the trial balance given outside the trial balance and the provision for doubtful debts provision for doubtful debts and the provision for doubtful debts. I believe you understood till here. Next, next, accounting treatment, accounting treatment of provision, accounting treatment of provision. Provision is a charge. Provision is a charge against the profit. Provision is a charge against the profits and is created by debiting profit and loss account. Profit and loss account. Profit and loss account. The disclosures of provision needs to be given. So kindly write disclosure of provision. Kindly write disclosure of provision. Provision is shown either on asset side either on asset side by way of deduction by way of deduction from from the respective from the respective asset in relation in relation to which, in relation to which it has been, it has been created, it has been created. Example, provision for depreciation, provision for depreciation is shown, is shown by way of deduction, by way of deduction from the, by way of deduction from the respective, respective fixed assets, respective fixed assets, respective fixed assets, provision, provision for doubtful debts, provision for doubtful debts is shown, is shown by way of deduction, by way of deduction from debtors, deduction from debtors, or on the liabilities, or on the liabilities, liabilities side, under the liabilities side, under the subhead, subhead provisions, under the subhead provisions. Example, provision for taxation or provision for tax. Example, provision for taxation or provision for tax. I believe you must have understood everything about provision now. We have seen the meaning of provision, examples related to provision, objectives of provision, need of provision, need for provision for discount on debtors, the accounting treatment, that it should be debited from the profit and loss account, the disclosure that is required in relation to provision. Let us shift to reserves now. Let us shift to another topic, reserves. Reserves. Meaning of reserves. Meaning of reserves. The term reserve, the term reserve refers to, the term reserves refers to the profits. The term reserves refers to the profits retained in the business, the profit retained in the business, not having, not having, not having any of the attributes, any of the attributes of a provision, any of the attributes of the provision. If, however, if, however, the provision the provision exceeds the amount amount which is required which is required to meet which is required to meet the or the liability loss or the liability. The excess is to be treated excess is to be treated as as reserves. In other words, in other words, reserve means reserves means accumulated or undistributed profits. Undistributed profits. Reserves means accumulated or undistributed profits. I believe you understood. Next, objectives of reserves. Objectives of reserves. First objective is to strengthen the financial position to strengthen the financial position of the of the concern to strengthen the financial position of the concern. Next, to provide funds. Next, to provide funds for the modernization modernization and or expansion and or of expansion of existing plant expansion of existing plant or acquisition acquisition of a new plant acquisition of a new plant. Third, to equalize the dividend to equalize the dividend during during the periods of inadequate inadequate profits during the periods of inadequate profits during the periods of inadequate profits. Next, to comply with legal requirements example debenture redemption reserve debenture redemption reserve capital redemption reserve capital redemption reserve under under the Companies Act under the Companies Act. development allowance, development allowance reserve, project allowance reserve, project allowance reserve under under the income tax under the Income Tax Act 1961. Under the Income Tax Act 1961, these are the objectives of reserves. These are the objectives of reserves. Let us continue. Types of reserves. Let us understand what are types of reserves. Types of reserves. Basically, there are two types of reserves. Two types of reserves. Revenue reserve, revenue reserve, and capital reserve, and capital reserve. First, revenue reserve. First, revenue reserve. Revenue reserve. Revenue reserve are revenue reserves are those reserves are those reserves which are which are created out of profits created out of profits available for available for distribution available for distribution by way of by way of dividend by way of dividend. Revenue reserve revenue reserves may be classified revenue reserves may be classified into two categories two categories as under. Revenue reserves may be classified under two categories. A. General reserve. General reserves. What is the general reserve? So basically students, general reserve are the reserve which could be used for general purpose. Any purpose you can use this reserve. There is no special purpose which is assigned to this reserve. So general reserve that reserve is that reserves which is not created which is not created for a specific purpose, not created for a specific purpose. Examples of such reserves examples of such reserves include general reserve, contingency reserve, contingency reserve, etc. etc. Another reserve is specific reserves. Another reserve is specific reserve. This is a special purpose reserve. Specific reserve is specific reserve is that reserve specific reserve is that reserve which is created specific reserve is that reserve which is for a created for a specific purpose created for a specific purpose. Examples of such reserves examples of such reserves include dividend equalization reserve, dividend equalization reserve, debenture redemption reserve, debenture redemption reserve. We'll learn about this chapter debenture redemption later. Investment investment fluctuation reserve, investment fluctuation reserve, workmen compensation workmen compensation reserve, compensation reserve, etc. etc. These are specific reserves and could be used for specific purpose. Revenue reserves are basically it is created from the revenue profits. The next is capital reserve. The next is capital reserve. Capital reserve. Capital reserve. Capital reserves are capital reserves are those reserves which are not created which are not created which are not created out of out of operating operating profits, not created out of operating profits. In case of in case of companies in case of companies the following are the following are the examples the following are the examples of capital profits of capital profits. A. Profits prior to incorporation. B. Premium on the issue of shares and debentures. C. Profits on reissue. Profit on reissue of forfeited share. Forfeited shares. D. D. Profit on redemption of debentures. Profit on redemption of debentures. E. Profit on sale of fixed assets. Profit on sale of fixed assets. F. Profit on revaluation of fixed assets. Profit on revaluation of fixed assets. G. Profit on sale of whole undertaking. Profit on sale of whole undertaking or a part of it or a part of it. Next, distinction between revenue reserve and capital reserve and capital reserve. Distinction between revenue reserve and capital reserve. Revenue reserve refers to revenue reserve the amounts refers to amounts which are which are free for distribution which are free for distribution by way of dividends by way of dividend, but capital reserve capital reserve refers to the amounts capital reserves refers to the amounts which are which are not free for distribution which are not free for distribution by way of dividend by way of dividend. Let us see the distinction between provision and reserves. Differentiate between provision and reserves. Distinction distinction between provision and reserves. Basis provision reserve, reserves. First is purpose, purpose. Provision is created, provision is created for a particular purpose, for a particular purpose. And can only be used and can only be used for that particular purpose. For that particular purpose. Reserves, it need not necessarily need not necessarily be created for a particular purpose. Example, general reserve is not for not for any particular purpose. Any particular purpose. Any particular purpose. Let us stretch these lines. Stretch these lines. Point number 2. Charge versus appropriation. Charge versus appropriation. Provision is a charge. Provision is a charge against the profit. Charge against the profit and and is required and is required to be created irrespective irrespective of the amount irrespective of the of profit amount of profit. Reserves, it is an appropriation. It is an appropriation out of profit and and can be created only if if profits have been earned. If profits have been earned. Third, disclosure. Third point, disclosure in income statement. Third point, disclosure in income statement. Provision is shown. It is shown on the debit side of profit and loss account. Reserves, it is shown on the debit side of profit and loss appropriation account. Profit or loss appropriation account. Fourth, point number 4, point number 4, disclosure in balance sheet, disclosure in balance sheet, disclosure in balance sheet. Usually, usually a provision, usually a provision is shown by way of by way of deduction by way of deduction from the amount by way of deduction from the amount of the item item for which for which it is created it is created. Example, provision for doubtful debts, provision for doubtful debts, provision for doubtful debts. Fourth, reserves. Reserve is shown reserves is shown as a separate item under the head reserves and surplus under the head reserves and surplus on the liabilities side on the liabilities side of the balance sheet on the liability side of the balance sheet of the balance sheet. Next point, investment outside the business. Investment outside the business. There is no question of investment. There is no question of investment of the amount of of provisions for reserve. The amount of a reserve the amount of a reserve can be invested outside the business. Outside the business. Point number 6, utilization for dividends. Utilization for dividends. Provision. It cannot be utilized for distribution. It cannot be utilized for distribution by way of dividends, by way of dividends. It can be utilized for, it can be utilized for distribution, it can be utilized for distribution by way of dividends, by way of dividends. Next point, legal necessity, legal necessity. It is made mainly because, it is made mainly because of legal necessity. There is a legal necessity to make provision in the Companies Act. Reserves. It is a matter of financial prudence. It is a matter of financial prudence. So this was about the difference between provision and reserves. Let us move ahead. Let us move ahead and begin with a new topic, that is change in the method of depreciation when it is permitted, basically. Change in the method of depreciation. Change in the method of depreciation. When can a change, when can a change in method of depreciation be made? Method of depreciation be made. If, if adoption of new method, if adoption of new method is required, adoption of new method is required by law, by statute, that is law, to comply with accounting standard, to comply with accounting standard, to comply with accounting standard. And third, to have, to have more appropriate, to have more appropriate preparation, to have more appropriate preparation and presentation, to have more appropriate preparation and presentation of financial statements. This simply means better presentation of books of accounts. This simply means better presentation of books of accounts. So in these three cases, the depreciation method could be changed. The first case is by law, by statute. The second case is to comply with the accounting standard. Supposingly there is a change in the accounting standard. An accounting standard wants you to change the method of depreciation. So you need to change it because you have to comply with the accounting standard. Third, you feel that bringing the new bringing the new method of depreciation will, there would be a better presentation in the books of accounts, and to have more appropriate presentation and preparation of financial statements of an enterprise. In that case, you can definitely change the method of depreciation. Next point. Next point. Calculation of calculation of depreciation. Calculation of depreciation. Depreciation. Depreciation should be recalculated. Depreciation should be recalculated as per as per new method, as per the new method from from the date of asset coming into use. Date of asset coming into use. Next, please write third point. Treatment of deficiency. Treatment of deficiency. The deficiency the deficiency should be debited. The deficiency should be debited to to statement of statement of profit and loss of the year. Statement of profit and loss of the year in which method of depreciation in which method of depreciation is changed. Method of depreciation is changed. Let us see its journal entry. Journal entry. Let us see its journal entry. Journal entry is profit and loss account debited to fixed assets account. Profit and loss account debited to fixed assets account. Next point. Treatment of surplus. Treatment of surplus. Treatment of surplus. The surplus should be credited to statement of profit and loss of the year in which method of depreciation is changed. Method of depreciation is changed. Let us see the journal entry. Journal entry. Journal entry. Fixed assets account debited. Fixed assets account debited to profit and loss account. Profit and loss account. I believe you must have understood. Fixed assets account debited to profit and loss account. Let us move ahead. Let us move ahead. Let us do the notings for revaluation method. Revaluation method. Revaluation method. This method, this method is also known as, this method is also known as inventory method. Inventory method or inventory system or inventory system of depreciation. System of depreciation. This method, this method is followed. This method is followed in case of assets, assets which are larger, assets which are larger in quantity, assets which are larger in quantity but have but have small value, such as such as loose tools, loose tools, bottles, sacks, package materials, package materials, etc. This method this method is also used this method is also used when life of an asset life of an asset cannot be cannot be ascertained with certainty certainty. Example: livestock, etc. Livestock, etc. I believe you understood. I believe you understood this. Let us continue. Under this method, the assets concerned, the asset concerned is revalued, is revalued at the end of every year. At the end of every year, on account of usage or any other cause, on account of usage or any other cause, the value the value the value at the end of the year the value at the end of the year is likely to be lower to be lower than the value at the beginning, at the beginning, at the beginning of the year, at the beginning of the year. The difference, the difference, the difference between in the two figures, in the two figures, decrease in value, decrease in value is charged as depreciation, is charged as depreciation. The method, the method of calculating, the method of calculating depreciation is given below. Calculation of calculation of depreciation under revaluation method, under revaluation method. book value book value of the asset, of the asset in the beginning, book value of the asset in the beginning, add purchases, add purchases, less, less sale proceeds, less sale proceeds of the asset sold during the accounting period, during the accounting period, less, less revalued figure, revalued figure of the asset, of the asset at the end, revalued figure of the asset at the end. What we'll get is depreciation, depreciation to be charged, depreciation to be charged. Calculation of depreciation under revaluation method. book value of the asset in the beginning, add purchases, less sale proceeds of the asset during the accounting period, less revalued figure of the asset at the end, what we get is depreciation to be charged. Depreciation to be charged. Write a note over here. Write a note over here. Note. If the revalued figure, if the revalued figure of the asset, if the revalued figure of the asset at the end at the end exceeds the book value, exceeds the book value, exceeds the book value of the asset, exceed the book value of the asset at the end, at the end, such such appreciation, such appreciation should be, such appreciation should be ignored, such appreciation should be ignored, and the book value, and the book value and the book value instead of revalued figure, and the book value instead of revalued figure should be should be should be deducted deducted as aforesaid, as aforesaid. Kindly read the note once more, it's important. If the revalued figure of the asset at the end exceeds the of the asset, book value of the asset at the end, such appreciation should be ignored, and the book value instead of revalued figure should be deducted as aforesaid. The accounting treatment, the accounting treatment of depreciation, the accounting treatment of depreciation under this method, the accounting treatment of depreciation under this method is similar to that of fixed installment method, to that of fixed installment method, or diminishing or diminishing balance method, or diminishing balance method, that is, it is debited to it is debited to depreciation account, it is debited to depreciation account, and and credited to credited to the concerned asset account, credited to the concerned asset account. I believe you understood till here. The accounting treatment of depreciation under this method is similar to that of fixed installment method, that is straight line value method, and written down value method, that is diminishing balance method. It is debited to depreciation account and credited to the concerned assets account. I believe you understood. Let us write an illustration. 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 On 1st April 2017, the value of loose tools, the value of loose tools was rupee 20,000, and and during the year and during the year rupee 10,000, and during the year rupee 10,000 worth of tools were purchased were purchased and rupee 2,000 realized realized by way of sale of scrapped scrapped loose tools. At the end of the year, at the end of the year, the loose tools the loose tools are considered the loose tools are considered to be worth only rupee 12,000. The loose tools are considered to be only worth 12,000. Required required calculate 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 the amount to be charged to profit and loss account. Profit and loss account. Calculate the amount to be charged to profit and loss account. Kindly read the question once more. On 1st of April 2017, the value of loose tools was 20,000, and during the year rupee 10,000 worth of tools were purchased and rupee 2,000 realized by way of sale of scrapped tools. At the end of the year, the loose tools were considered to be worth only 12,000, so there is a revaluation in the loose tools. Calculate the amount to be charged to the profit and loss account because of this. I believe you understood this. Let's solve it. Solution. 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 Calculation of amount calculation of amount to be charged to profit and loss account. profit and loss account, right, particulars, rupees, opening balance, opening balance of loose tools, opening balance of loose tools, 20,000, opening balance of loose tools, 20,000, add, add, purchased during the year, purchased during the year, opening balance of loose tools is 20,000, purchased during the year is 10,000 and 2,000 realized by way of sale. Purchased is 10,000 less, less, sale of scrapped loose tools, sale of scrapped loose tools 2000, closing balance of loose tools, it is revalued to 12,000. As you have seen, it is revalued to 12,000. Last line, considered to be, the loose tools are considered to be worth only 12,000. The loose tools are considered to be worth only 12,000. So closing balance of loose tools, this is 12,000. This is 12,000. So 20,000 plus 10,000 minus 14,000. So 30,000 minus 14,000. 30,000 minus 14,000 is 16,000. Depreciation, depreciation to be charged, to be charged to profit and loss account, profit and loss account is 16,000. Depreciation to be charged to profit and loss account is 16,000. I believe it is clear. I believe it is clear. Let us move ahead. Let us move ahead and learn about a new method, that is double declining method. Double declining method. Double declining method. Double declining method. Double declining method is one of the accelerating method, one of the accelerating method of depreciation, of depreciation, which depreciates, which depreciates the assets, which depreciates the asset at higher rate, at higher rate, which depreciates the asset at higher rate in the earlier years, in the earlier years, and at lower rate, and at lower rate in the later years, later years. Under this method, under this method, under this method, a fixed, a fixed double declining percentage, a fixed double declining percentage calculated upon, calculated upon the diminishing value, calculated upon the diminishing value, value of the asset, value of the asset is written off, is written off in each, written off in each accounting period, in each accounting period, accounting period, during the, during the expected, during the expected useful life of the asset, during the expected useful life of the asset. The double declining rate, the double declining rate is calculated, the double declining rate is calculated ignoring the scrap value, ignoring the scrap value as under rate of depreciation, rate of depreciation in percentage, rate of depreciation in percentage equals 2 divided by n multiplied by 100, 2 divided by n multiplied by 100, where n equal to, n equal to useful life of the asset, n equal to useful life of the asset in years, in years. Write a note over here in relation to this. Write a note. In the last year, in the last year of the useful life, in the last year of the useful life of the asset, in the useful life of the asset, wow, in the last year of the useful life of the asset, the depreciation amount, the depreciation amount should be, should be charged in, charged in such a manner, should be charged in such a manner that the book, that the book value of the asset that the book value of the asset after charging book value of the asset after charging depreciation after charging depreciation is at least is at least equal to the estimated scrap value estimated scrap value of the asset estimated scrap value of the asset estimated scrap value of the asset. In the last year of the useful life of the asset, the depreciation amount should be charged in such a manner that the book value of the last year, the book value of the asset after charging depreciation is at least equal to the estimated scrap value of the asset. So this is double declining method. I believe you understood. I believe you understood this. Let us see what we have done in today's class. Let us see what we have done in today's class. We have done an illustration in relation to provision for repairs and renewal account. We have solved this provision for repairs and renewals account. Then we have learned the meaning of provision, examples of provision, objectives of provision, need for provision account, why it should be prepared, accounting for treatment of provision, the disclosure of provision. Then we shifted to reserves. We learnt about the objectives of reserve, why it is created, what kind of reserves are there. So types of reserves, revenue reserves, capital reserve, specific reserve, general reserve, distinction between reserves and capital. You've seen the distinction between reserves and capital. In which circumstances the change in the method of depreciation is permitted. So there are three circumstances. How to calculate depreciation, the treatment of deficiency we have learned on the basis of journal entries. Then we have also learned the revaluation method in detail. The revaluation method, how the calculation of depreciation is done under revaluation method. We have seen an illustration, calculation of amount to be charged to profit and loss account. And at last we have learnt about the double declining method. At last we have learnt about the double declining method. And we have written an important note in relation to double declining method. Students, we are stopping here. We are stopping here. We'll be doing multiple choice questions, theoretical questions, and practical questions in the next class. Thank you. Thank you.